A very good afternoon, one and all. Myself, Arpan Patel, on behalf of Faculty of Commerce, Parul University, I welcome you and all on today's webinar, that is Bond Valuation, Why and How. Today we have expert Dr. Mital Thakkar, who has been working as an assistant professor in Commerce and Management in C.P. Patel and F.S. Shah Commerce College, Anand, since 2008. She is M.Com, M.Phil, PGD HRD, and PhD degree holder. She has a vast experience of decades of undergraduate and postgraduate levels. Moreover, she has also cleared UGC NEET, Commerce exam, and GSAT exam. I request Dr. Mital Thakkar to to give a good knowledge regarding bond valuation, and I welcome you, Dr. Mital Thakkar, ma'am.
Thank you for a lovely introduction, Arpan sir.
Thank you, ma'am.
Before I start my presentation on bond valuation, why and how, I would like to thank management of Parul University, Dr. Ajay Trivedi sir, Dean and Professor, Department of Commerce, Parul Institute of Commerce, Parul University, Dr. Divyang Vyas sir, and Dr. Arpan Patel. I am also thankful to my existing employer for providing me all the facilities to conduct this particular webinar. Okay, so let's move to today's discussion, that is on bond valuation, why and how. What I would like to discuss today is why to do bond valuation. Then we'll just discuss in brief what is bond and what is bond valuation. Our major discussion will held on bond valuation how. That is, we are going to include several topics like how to do valuation of redeemable and irredeemable bond, how to do calculation of bonds value when interest is paid semi-annually by the issuer. At the same time, many companies prefer to redeem the bond in installment rather than redeem it in a lump sum at the end of maturity. So we are also going to include this topic. After it, we'll move to the relationship between required rate of return and the coupon rate. This thing I would like to explain you with the help of one small example, and at last I will discuss about YTM, that is yield to maturity of a bond. Now, before I start with my presentation, I would like to request all the participants, specifically student participants, that please be ready with your calculator, book and pen. So whenever you find something practical is there, you can calculate it by your own. If you find the content relevant and useful, then you can also take screenshot of the same. Okay, so now let's start with the bond valuation. Why? Once you see this particular topic, the very first question comes in mind is why to do bond valuation and why to attend this particular webinar. Okay, so we know that as an investor, when we are making investment decision, we are in the decision dilemma, right? Say what to purchase, in which company security we have to do investment. Okay, and one thing we all know, that investment is a long term activity. Ultimately what we are committing is our savings, right? So at that time we would like to find the security which offer us superior return, right? Everyone would like to pick the stock that is offering promising return. Okay, and one common thing that every investor prefer is minimizing risk and maximizing return. Okay, so this is the reason that we have to follow fundamental analysis while taking every investment decision. Our fundamental analysis basically start with economic analysis. In economic analysis, we are specifically making attempt to find out the economy which is offering us good, which is we can say which is having some conducive environment for investment purpose. Okay, here we would like to focus on major economic indicators like the GDP of the economy, inflation rate, interest rate. We can see a country's fiscal policy, monetary policy. We can check international influence, short term and long term growth prospect of the economy we can examine. Okay, so by making all these attempts, first we find out which economy is worth for making our investment decision. After conducting economic analysis, we can move to industry analysis. Industry analysis is nothing but making choice of a specific industry which again fulfill our return expectation. Just as I told you, we as an investor always like to maximize our expected return, right? So here we see, right, at which stage of industry life cycle the industry is working. Okay, many times we perform cross sectional industry analysis, that is we check which rate of return is offered by one industry and what is the rate of return offered by other industry. Okay, we can also see industry's growth rate, right? We can also check several indices related to industry which are available ready-made, right? When we just visit website of any leading stock exchange like BSE, NSE. Okay, so by making all such efforts, we can find out which industry is good for our investment purpose. After it, we would like to find out the company. Okay, this is the ultimate reason why we are performing economy and industry analysis. Our choice is basically located is at any specific company that is offering a superior return. Okay, because as I told, okay, we are committing our fund for a longer duration and we are interested to maximize our earnings. So it is advisable that we perform fundamental analysis properly so that we can find out which company is good for our investment decision. Okay, so once you locate your choice to a particular industry, then you start choosing which company is offering highest return, which company is having good track of record, which companies ratios are showing satisfactory, right? Which companies profits are increasing. Okay, so we examine all the qualitative and quantitative indicators of a company, and thereby we select one company which is good for our investment purpose, right? So these are fundamental analysis which include economic, industry and company analysis is known as a top down approach or EIC approach of investment process. Okay, why we make company analysis? Then basically to find the security which is offering a superior or promising return. Okay, now uh, when we select any particular company's security, right, at that time we would like to see what is the prevailing price of that security in the market, right? But listen, whenever we are taking decisions related to investment, our decisions are not solely based on the prevailing price or market price of the security, right? Rather, we would like to compare price of the security with its value. Okay, now again the question come in mind is why this comparison required. Okay, so we would like to compare value of the security with its price so that we can find out whether the security can be purchased or not, right? Because in market we can see that many times the security is underpriced, many times the security is overpriced, right? And we as an investor would like to find out which securities are overvalued, which securities are undervalued. Okay, so for this thing we need to study relationship between value and price. Now the decision criterion is when you find out the calculated value is greater than the price of the security, it signals that the security can be purchased. Means as an investor you can buy the security. Opposite to it, when you identify that the value of the security is less than the price, it signals that it is a time to sell the security because you are getting good return. When you find both the value and price are equal, right, it is advisable not to trade in that particular security. Okay, now many people consider value and price as a similar, but basically both the things are not similar. Okay, I would like to give you one example. Okay, suppose as a buyer when you are going to buy say some fruits, or you are going to buy say some mobile phone or any particular thing, right? So at that time whenever you go to that particular shop, you will ask the seller that what is the price of this product, right? When the seller will inform you or will communicate the price of the product, you would like to compare the price with the value, that is how worth the particular goods or services for you, right? How much it worth to you. Okay, so there we are judging the value of the particular product with compared to its price, right? I would also like to tell you that you always see, right, okay, whatever you are paying against it, how much value or utility you are gaining from that particular product, or you can say goods or services, right? So in brief, we can say that when we are talking about value basically differs from person to person. It is not similar or identical. And again, one more thing about value is it is basically utility or worth of a goods or services in the eyes of a customer. But when we talk about price, we can say that price we can ascertain or calculate from the customer's perspective or from say market perspective. One more thing is price is identical for everyone, whether you go for buying, whether I go for buying, price will remain similar, right? It is common for all, but value differs from person to person. Particular goods may value much for me, right, but may be less valuable for you. Okay, so this is the reason we are calculating value of the goods, services, or in our financial management. And specifically in today's context, we are learning calculating value of a. Okay, so one thing that I would like to clarify in respect of today's webinar is that by valuation, or whenever I use the word valuation, I mean to calculate present value, right? In bond valuation, our attempt is to calculate present value of bond. Price, just as I told you, it can be ascertained by customer's perspective, by market perspective, or we can say by common consensus or opinion of the market, right? Price is readily available. We are not making any attempt to calculate it, right? But we have to make all the attempt to calculate value of the securities. Okay, now bond valuation that we are discussing today is basically part of the topic valuation of security. Valuation of security is a very broad topic, and in finance generally valuation of security includes valuation of equity share, preference share, and bond or debenture, that is fixed income giving security. Okay, so it is not possible to cover all the three aspects in this much time, right? So that is the reason we are only focusing on bond valuation. Now before you learn bond valuation, it is important for everyone that you have to be clear with the concept of time value of money. Time value of money is a very important concept of financial management. Being a finance student, one should be clear with the concept of time value of money. When we speak about time value of money, this concept is basically grouped into two major areas. One is a concept of present value and another is a concept of future value. When we are talking about calculating present value, we must be clear with its meaning that present value is nothing but the value today of a sum to be received at some future point of time. Okay, so the money you are going to receive in future, but you are calculating its present value so that you can take some investment decision. Okay, when we talk about future value, it describes that future value means by finding the value what an investment today will grow to in the future, right? So it is nothing but the opposite of finding or calculating present value. Now see, the process we are computing to calculate present value is basically considered as a discounting process, right? Remember this thing, discounting and compounding is also two major important concepts with respect to time value of money. When we calculate present value, right, what we are using, the formula is future value 1 divided by 1 plus r raised to power n. Here n refers to number of years, right? So let me give you one example for the same. Suppose we are taking a bond which is having its value 1000 and maturing after 5 years, and appropriate applicable discount rate for the same is say 10%. If we want to calculate present value of this bond by using above equation, we can say that its face value is 1000 rupee, right? And discounting rate is 10%. So I would like to write 1 divided by 1 plus 0.10 raised to power 5, right? If you will do 1.10 into 1.10, right, means you will do it 5 times, you will find the value 0.621. Okay, you can verify this in your calculator. When we multiply 1000 with 0.621, it will give us value 621. Okay, so what it indicate, the 1000 rupee that you are going to get after 5 years, its present value is 621. Okay, now when we calculate present value, again three possibilities are there. We can calculate present value of lump sum, just like I have shown you in the example. This is example of present value of lump sum. And one more thing here, I have written about zero coupon bond, right? Means the bond which is not giving interest, just we are going to get the amount at the end of redemption time. Okay, we can also calculate present value of uneven cash flow. Uneven cash flow means the cash flow will not be identical for all the years, right? Suppose at the end of first year I get 200, at the end of second year I get 500, at the end of third year I get 700. So you can examine that the cash flow at the end of every year differs, right? So this is an example of uneven cash flow. We can also calculate present value of such cash flow. The same thing we will learn in detail in bond redeemable in installment topic. Then we can calculate present value of even cash flow, which we can also call annuity, right? Present value of annuity. It indicates that the cash flow will be identical for all the years, right? It means it will remain similar. For future value, we can use the formula future value is equal to present value 1 plus r power n, right? But this thing is basically right now not needed to learn bond valuation, so we are not giving much of our time for calculating future value. Okay, now let's move to our topic, what is bond and what is bond valuation. I think you all have learned what is bond in our earlier classes. So what is we can briefly include that bonds are any debt security which is specifically issued for a longer duration, and the issuer can be any company, any government corporations or government entity, right? So whenever any organization thinking to raise debt finance, they would like to issue bond. As an investor, when we invest in bond, we receive periodic coupon payment. We can call coupon payment interest payment also. At the end of the year, that is at maturity time, we are going to get back redemption repayment. Okay, that is what the terminal value is. Okay, now each payment that we received, that is interest payment as well as payment at the time of maturity, is called as a cash flow to the investors. Now, what is bond valuation? Bond valuation is nothing but calculating present value of bond. Just as I told, whenever in this particular session we speak valuation, we used to convey present value. Okay, because there are different concepts associated with the word value. Okay, might be you have heard the securities book value is there, market value is there, going concern value can also be there for any particular entity. Okay, liquidation value can be there, that is value we decide at the time of closer down of a business, right? So even the word value convey different meanings, right? But when we speak the word value, we use to indicate present value of a bond. Okay, so present value of bond is the discounted value of cash flow. Here cash flow again consists of, just as I explained you, that when we speak cash flow, it indicates that we used to convey coupon payment, that is interest payment, and payment that we receive at the time of maturity, right? So these would be our cash flow. When we discount this cash flow with appropriate discount rate, we will get present value of the security. Okay, and this value we can compare with the market price, so that we can take decision whether the security is overpriced or underpriced. Okay, based on its evaluation of overvalued and undervalued, or you can say overpriced and underpriced, you can take decision whether it can be purchased or not to purchase, right? What I have explained you in this particular slide, right? Okay, you have to compare value with the price. If value is greater than price, buy it. If value is greater than, if value is less than price, just sell it, right? So for taking this decision, what we have to do is a bond valuation. Okay, so now I think you all are clear with why to learn bond valuation, right? As an investor, when you want to take any informed investment decision, you have to calculate present value of the security. Okay, so in whatever security you are going to commit fund for a longer duration, you can just calculate its present value, then take decision whether the security can be purchased or not. Okay, our next discussion will be on valuation of redeemable bond. Okay, now based on the maturity, we can say that the bonds can either be redeemable, either it can be irredeemable. For a valuation purpose, we would like to use different process for calculating value of redeemable bond and for calculating value of irredeemable bond. First, have a look on a valuation of redeemable bond. The value of bond may be defined as the sum of present value of future interest payment that you are going to receive for all the years of a maturity or for all the years you are going to hold the bond. Okay, and present value of redemption repayment. Okay, now again for calculating valuation of redeemable bond, we have a two methods. You can go for this formula, and at the same time you can also use present value table. Okay, it's up to you which method you would like to use, but majorly all are using present value table because it would be difficult to use the formula when the maturity period is comparatively greater, or you can say larger. Suppose I would like to tell you that if you are buying a bond which is having say maturity period of 8 years, right? So at that time what happen, you have to write this particular component of this formula 8 times, right? Because for 8 consecutive year you are going to get interest, and at last, that is again at the end of 8 year, you are going to get redemption value, right? Which is we can also considered as a terminal cash flow. Okay, so this would become somewhat complicated, specifically when we are in hurry and when we want to find out quick answer, right? So you can use it if you find it. Okay, it is basically easy and the bond are having lesser duration, then definitely you can go for it. Otherwise it is advisable just use present value table, and I think you all are having idea regarding how to use present value table. Can any student give me answer that whether you are clear with seeing present value or not? Students, do you have idea how to see present value with the help of present value table? You can use chat box for giving your answers. Do you have idea how to see value in present value table? Student, my question to all the student, anyone can give answer in chat box. So you don't have idea, right? Okay. So let me tell you about it in brief, that whenever you see present value table, which is basically you can find it in any book of finance, right? Just see last pages of any book and you will find this particular table. You can refer Financial Management by I.M. Pandey or Khan and Jain, right? In every book, present value table is there. Okay, so when you see this particular table, you will find it two table, right? Present value of lump sum rupee 1 and present value of annuity. When cash flow is even or similar, you can use present value of annuity. When cash flow is uneven for all the years, you can use present value of lump sum of rupee 1, right? So this is the thing you have to remember while using present value table. Okay, now let's see one example, and we would like to calculate its value using both the method. Okay, see, this is the example I would like to communicate with you. An investor is considering to purchase 8% bond of rupees 1000 each, redeemable after 5 years at par. The investor's required rate of return is say 10%. What should he be willing to pay now to purchase the bond? Now, if you use formula method, just as I told, you have to write this particular part of the formula for all the years till you are going to get coupon payment. Okay, so just see in the question, we are considering to buy a debenture or a bond of rupees 1000, which is having life of a 5 year. So what it indicate, at the rate of 80%, you are going to get interest till 5 years. Okay, so just calculate interest, 1000 into 8 divide by 100, right? Means 8% of 1000 will be 80 rupees. Okay, so here it indicate 80 rupees you are going to get for 5 years, right? At the end of first, second, third, fourth and fifth year, you will get 80 rupees. Again, in the fifth year, along with 80 rupees, you will get your principal amount back. It means your 1000 rupees will be given back to you in the fifth year, right? So we can write that 80 divided by 1 plus 0.10 raised to power 1 extended till 5, right? And in last we'll write 1000 divided by 1.10 raised to power 5. When you solve this particular thing, you will find the value 924.17. Okay, now it seems easy when you see it on a screen, but when you practically solve it, you will find difficulty, specifically when you do 1.10 into 1.10 into 1.10 into 1.10 5 times, right? It may take some time, right? But rather, if you use present value table, you can just simply solve it in a two line. Okay, see here what is going to happen. For 1 to 5 year, you are going to get 80 rupees interest. I hope it is clear to all how this 80 arrives. Student, is it clear how I have written this cash flow 80 rupees? Now you have to interact, right? So that I can find whether you are getting my point or not. Is it clear to everyone how I have written this 80 rupees? See, in the cash flow column, you will find two values up to 1 to 5 year, 80 I have written, and in the fifth year, I have written cash flow 1000 rupees. Okay. So, how these 80 rupees arrives?
Ma'am, 8% of 1000.
Yes, exactly. It is 8% of 1000, right? And in the fifth year, when the bonds will redeem, we will get our 1000 rupees back, right? Now, what we have to do? See, now you would like to use present value table, right? So that you can just find out present value at the rate of 10%. Again, let me show you present value table. So I hope this present value table is visible to all of you. hope now you can see the present value table. Just as I told you that in present value table, you will find two table. You have to just read this title, present value of rupee 1, right? So whenever you identify the cash flow is uneven means not equal for all the years, at that time you have to use this particular table, right? But when you identify the cash flow is equal or even, at that time you have to use this second table, that is present value of annuity of rupee 1, right? Now while seeing present value table, in upper line you will find all the percentage are there, right? This is nothing but the discount rate or interest rate which is given to you in example. Just like whatever example I explain you now, in it you can identify that the rate is 10%, right? The example which I recently explained, in it you can identify present value. We have to see at the rate of 10%, right? So whenever again I will share my slides to you, you will identify that the value I have written is 3.791, right? So that 3.79 I have written from this particular table. Again, when you see that in the 5th year, when I will get back my redemption repayment, that is 1000 rupee, against it I have written the value 0.621, right? So that 621 I have written from this particular table, present value of rupee 1, right? So this is how you have to see these particular values from the table. As I told, you can easily find this table from any particular book of financial management. Okay, just you have to be careful while seeing values, that proper discount rate should be selected, and in the year column you have to see in the right row against the particular year. Okay, so now let's be back to our discussion. Just hold a while, I am coming back to my presentation. Okay, so hope the screens are again visible to all. So just as I show you in the table that the value I have written is from present value table, you can see present value factor at a 10% discounting rate from the present value table. It is 3.79 in the present value of annuity table and 0.621 from present value of lump sum rupee 1 table. So when I multiply cash flow with a present value factor, I will get the value 303.28 and rupees 621. When I do summation of both these value, I will find out 924.28. Okay, so what this value indicate? The value of a bond which you are thinking to buy, right, and which is going to give you 1000 rupees at the end of 5 years. Its present value is 924.28, Okay, now based on this value, you have to take decision whether you should buy the bond or not. Now, this is what we have to do when the bonds are redeemable. Okay, again, when you read the question and you have to find out whether it is example of redeemable or irredeemable bond, then you have to just read the question and find out whether maturity period is given or not. If in a sum it is given there is a maturity period, it means you have to apply the calculations of redeemable bond. If the bonds are not going to mature, means maturity period is not stated in the question, it means the bonds are irredeemable. It is quite easy to do calculations of value of irredeemable bond. What we are required to do is just simply divide interest with a KD, that is your required rate of return. Okay, so here the formula will be V is equal to I by KD. V is a nothing but the present value of bond that we are discussing to calculate in our today's webinar. KD is a required rate of return on bond. What is required rate of return for an investor? It is nothing but that rate what an investors are expecting that the similar securities of the same characteristics are going to offer them, right? We call that rate required rate of return. See, when I speak my required rate of return is 12%, it means I am ready to buy this security when it offers me 12% return. Okay, here I stands for interest, or you can also call it coupon payment, right? Let's see one example of the same. Say Mr. A is there and who wants to buy a perpetual bond having face value of rupees 1000, and he is going to receive rupees 60 as an annual interest payment. What will be the value of a bond if investors require rate of return is say 10%, right? So here see, I, that is interest, it is explicitly given in the question, rupees 60 he is receiving as annual interest, right? And KD, that is required rate of return, it is stated in the question that it is 10%, right? So when I write 10% in point, I can write 0.10, or if you write 10%, just don't forget to press this percentage tab in a calculator, right? So when you do 60 divided by 0.10, the value you will get is rupees 600. Here again this 600 states that this 600 is a present value of bond. Okay, based on it you have to take decision whether you would like to purchase the bond or not. Next important concept in a bond valuation is how to do valuation of a bond paying semi-annual interest or semi-annual coupon payment. In practice, you can find that many companies would like to pay interest semi-annually rather than giving it at the end of year, right? So whenever we are doing valuation of such bond, we have to keep in mind that 3 adjustments we need to implement. First adjustment is annual interest amount, that is I, should be divided by 2. Second important adjustment required is maturity period N should be multiplied with a 2. And the third adjustment that we have to apply is a required rate of return, that is KD, should be divided by 2. Right? Again, remember, annual interest amount, that is I, should be divided by 2. Right? Maturity period N multiplied with 2, so that you can find out number of half yearly payments you are going to receive. Required rate of return KD, it should be divided with 2, right? So I and KD you have to divide by 2 and N you have to multiply with 2, right? Let's apply these 3 adjustment and do one exercise. Assume Mr. A is again thinking to buy rupees 1000 par value bond, which is having coupon rate of say 10%, and the bond matures after 5 years. Here interest is payable semi-annually. What will be the value of bond if investors require rate of return is say 18%, right? First look on this particular part of the question. Later on we will focus on what will be the change in the price if interest is paid annually, right? So don't look on this particular part, just try to understand how we will calculate if interest is paid semi-annually. So these 3 adjustments first I would like to apply. Okay, so let's calculate interest first. rupees 1000 is the value of the bond, and coupon rate, that is interest rate, is 10%, right? So interest will be 1000 into 10%, 100, right? But as stated in the previous slide, the interest amount should be divided by 2, right? So 100 by 2, so interest will be 50 rupees. Clear? Then second adjustment, the maturity period end should be multiplied with 2. Here, refer the question, it is given that the bond mature after 5 years, right? So this 5 should be multiplied with 2. So it will become 10, right? 5 into 2, obviously it becomes 10. Refer the third adjustment we would like to implement is required rate of return, KD, should be divided by 2, right? So here, refer the question, required rate of return is 18%. I would like to divide it by 2, right? So it will be 18 by 2 means 9%, right? Now I can solve the example using the similar method that I have shown you in valuation of redeemable bond, right? The same method we have to apply. Okay, just the care we have to undertake is making these 3 particular adjustment. So for 1 to 10 year, I am going to get 50 rupees present value. When I'll see in the table at a 9% rate, I can identify this value. When I multiply cash flow with this present value, I can notice it is 320.9. In the 10th year, when I'll get my redemption repayment, that is 1000 rupees, and when I identify present value at 9%, in the present value of annuity table, I can notice this particular value, and when I multiply 1000 with 0.422, it will be 422, and the total of both these values is 742.90. Okay, so this is the present value of bond. Okay, now I want to make you understand that what is the change in the price if the company thinks to pay interest annually. Okay, so if the company thinks to pay interest annually, we have to use the same approach as I have explained you in the case of valuation of redeemable bond, right? Just write, for 1 to 5 year you are going to get 100 rupees, in the 5th year you are going to get 1000 rupees back, right? In the column of 18% discount rate, you will find this particular value, right? In the 5th year's row, right? Here you have seen value in the 10th year's row. Here you have to see value in the 5th year's row, right? When you multiply cash flow with the present value factor, you will identify this value. Here, total present value of bond will be 749.7. So you can notice that there is a no major difference in the value, whether the company pay interest semi-annually or whether it pay annually, right? Almost 6 to 7 rupees difference is there in the value. Now, many times it happens, company can take decision to redeem bond in installment rather than redeem it in a lump sum at the end of maturity. It means, they say, if I am a issuer of bond and my bonds are of rupees 1000 each, and I have decided that the maturity period of the bond is say 4 years, right? Now here I have two options. I can give you 1000 rupees back at the end of 4th year. I can also take decision that at the end of each and every year I will give you rupees 250 back, right? So what happened when I opt for the second option, that is giving you 250 rupees at the end of each and every accounting year, then it will basically reduce my financial burden, right? So many times company may take such decision that they would like to redeem bond in an installment, right, rather than redeem it in a lump sum at the end of a maturity, right? Because it reduces company's financial burden in the last year, that is in the at the time of maturity period. Okay, so this thing will be more clear when you identify the same in one question or one example. Okay, so just pay your attention on the screen and you will find out one question relating to it. A company is proposing to issue 5-year debenture of rupees 1000 each, redeemable in equal installment. This bond carry coupon rate of 14%. If investors minimum required rate of return is say 10%, what will be present value of debenture? Okay, now mind well, when you identify any questions relating to such bond redeemable in installment, first you have to calculate cash flow for all the years, right? This is the first important step. Once you be clear with the calculation of cash flow, you can calculate present value of cash flow. Okay, so it is important to pay attention on this particular step. Okay, now see, what you have to do is first see, okay, for how many, what is the life of the bond, that is for how many years the company have issued the bond. Here you can identify the life of the bond is 5 years and its value is rupees 1000, right? So company is thinking to redeem it in a equal installment. So when you divide 1000 by 5, you will get 200. What it means, at the end of first year, company will give you 200. At the end of second year, company will give you 200. At the end of third year, same 200. At the end of fourth year, similar way, 200. At the end of fifth year, again in the same manner, you will get back 200. Okay. Now, if you calculate interest or coupon payment, in the first year, you will get interest on 1000 rupees. So 1000 into 14%, obviously it will be 140, very simple calculation. Again, along with this 140 interest, company will give you first installment of principal amount, that is 200. Total you will get at the end of first year is 340 rupees, right? That is 140 plus 200. In the second year, if you calculate interest, then it will be calculated on 800. Why? Because the outstanding amount will be 1000 minus 200, so 800. So when you do 14% of 800, you will notice the answer is 112. Along with this interest, you will get principal amount back 200. Total cash flow will be 312. In the third year, interest will be calculated on 600 rupees because the outstanding amount will be 800 minus 200, 600. Along with this interest, you will get third installment of your redemption amount. So total cash flow will be 284 to an investor. In the fourth year, 600 minus 200, 400 will be outstanding amount and 14% interest will be calculated on the same value. So it would be 56 rupees. Along with 56, you will get fourth installment of your redemption amount and it will be 256. In the fifth year, you will get the last installment of 200 plus interest at rate of 14% on this outstanding amount 200. So it will be 228. Okay. Now see, this calculation would be cash calculation of present value of uneven cash flow. Just see, the cash flow for all the year is not even or similar. You can notice that for first year it is 340, for a second year again the different amount, again the different amount, right? So it is not identical. Okay, so for calculating present value of such cash flow, you have to use present value table or present value of lump sum rupee 1, which I have shown in the beginning part of showing present value table. Okay, so just apply the same 4 columns format. First we would like to include your, then we will write cash flow. Cash flow I have just taken from this last column. Then we will write present value factor at the rate of 12%. Again, just see present value table, and in the 12th year discounting rate column, you will identify these values for consecutive first, second, third, fourth, and fifth year. When you multiply cash flow with the present value factor, you will identify these values. And the summation of all the value is a present value of debenture. It is 1046.59. Okay, so this is how the calculation becomes difficult when company just take decision to redeem the bond in an installment, right? So you can notice that these calculations are identical, right? But only the use of present value table will be different, right? For the even cash flow, you can use the present value of annuity table, but for an uneven cash flow, you cannot use the same table. Clear? Most important part in a bond valuation is studying relationship between required rate of return and the coupon rate. Required rate of return, just as I explained you, it is that rate which as an investor we expect on a particular security. Coupon rate is the interest rate that the securities, in our case bond, is offering, right? Now when you identify required rate of return is equal to coupon rate, means say required rate of return is say 12% and coupon rate is also 12%. So here KD is equal to I. In such a case, when you calculate value of bond, you will identify it is equal to par value. But when you notice that required rate of return is greater than coupon rate, say it is 15% and coupon rate is say 12%, so the value of bond will be less than par value. And in the third case, when required rate of return is less than coupon rate, say assume required rate of return is 10% and coupon rate is say 12%, so here the value of bond will be more than par value. Now again, this thing will be more clear when you study it with the help of one illustration. First, we would like to prove that when required rate of return is equal to coupon rate, the value of bond is equal to par value. Refer this particular example. Say we have a bond of A Limited having these particular features. Its face value rupees 1000, its annual rate of interest 12%, maturity period of say 5 years, and required rate of return 12%. First, you pay attention on this rate. Coupon rate is 12%, required rate of return is 12%. So it is according to the conditions stated over here. Required rate of return should be equal to coupon rate. Now let's calculate value. Again, for 1 to 5 year, you will get interest at the rate of 12%. So again, 12% of 1000 would be 120. So as an investor for first, second, third, fourth, fifth year, you will get 120. Again, in the fifth year, you will get your 1000 rupees back. When you see present value table and identify rate at a 12%, you will identify these particular values. When you multiply cash flow with a present value factor, you can identify this value. When you make total, you can notice that it is 999.60. So it is nothing but 1000 rupees. Okay, you can take screenshot of it and you can later on examine the same thing by applying all the calculations, right? So thereby we are able to prove that when required rate of return, that is 12%, is equal to coupon rate, which is also 12%, the value of bond is equal to par value. Its par value is 1000 and the calculated value is also 1000. Okay, so is it clear, students? Is it clear to all? This particular content is a part of bond value theorem. The one part of bond value theorem basically indicate this relationship, right? So whenever in curriculum also you are going to study this particular chapter, you can find this thing. Okay, then second, we would like to prove required rate of return is greater than coupon rate, the value of bond is less than its par value. Okay, so again, say par value is 1000, annual rate of interest or coupon rate is 12%. Here I have put required rate of return 15%, which is greater than coupon rate. Right now, when I apply all the calculation, say for 1 to 5 year, I will get 120 interest. In the fifth year, I will get 1000 rupees back. When I see present value and I implement or apply it, I will find out that the total present value of bond is 899.24. Now compare it with its face value. See, its face value is 1000 and present value that we identify is 899. Okay, now compare it with the first line. The value of bond is less than its par value. See, obviously 899 is less than 1000, right? So present value of a bond is less than its par value. Such bond is called a discount bond. Third relationship is required rate of return. When it is less than coupon rate, the value of bond is more than its par value. Again, keeping all the values similar, I have just make change in the required rate of return. Say I make it 10% because I want to show required rate of return is less than coupon rate. right? So coupon rate is 12%, required rate of return is say 10%. When I calculate interest, put it in this column. When I identify present value and I multiply cash flow with a present value, I come to notice that the answer is 1074.92. So you can notice that the face value is 1000 rupees and the present value that I identify is 1074, right? So obviously just refer this line, the value of bond is more than par value. 1074 is more than 1000, right? So we are able to prove that when required rate of return is less than coupon rate, here my required rate of return is 10%, coupon rate is 12%. So I am able to prove this thing with the help of one example. Such bonds are called a premium bond. My last topic for today's discussion is the concept of yield to maturity. Many times what happen, rest all the things are given and what we require to calculate is a required rate of return. Okay, if you have studied capital budgeting, then in capital budgeting you have studied IRR method, that is internal rate of return method. If you remember, you have studied that internal rate of return is that rate which equate present value of cash inflow with present value of cash outflow. It means it is that rate when NPV of the project is 0, right? So this is nothing but that rate at which both the value become equal, that is present value of cash inflow and in our case the given price of the bond, right? So you can apply the same method which you have applied in the case of calculating IRR of any project, right? With the help of that trial and error method we can also calculate YTM, but again the calculation will be more difficult as well as lengthy, so we can use this approximation formula. Again, calculation of YTM differs for redeemable bond as well as irredeemable bond. First, we'll focus on calculating YTM of a redeemable bond. We can use this formula. It is known as approximation formula. You can calculate approximate YTM with the help of this formula. Interest plus 1 by n into bracket f minus p. Here I stands for interest, n is the number of years, f is nothing but the face value, and p is the stated price which you will find in the question. Divide by 1/2 f plus p. Let's try to understand it with the help of one example. Say current price of rupees 1000 and coupon rate is coupon rate is 8% for a bond, and the bond is going to mature after 5 years and its price is say 1020. What will be YTM? Now we would like to put all this value in the formula. I, that is interest, is 8% of 1000, so 80 rupees. N, maturity period is 5 years, so I will write 1 by 5. F, that is face value is 1000, and P, present price is 1020. Okay, so you can identify that 80 minus 4 divided by 1010, it will give you 7.52%. This is your required rate of return on this particular bond. If you want to calculate YTM of irredeemable bond are also known as a perpetual bond that are not going to redeem. Okay, so in this case it is quite easy. What you require to do is just simply I divide by P. Here I is the interest on coupon payment and P is a price, that is market price, which is there in the question. For this example, say Mr. A has a perpetual bond of rupees 1000 and he receives interest of rupees 60 annually. So in this case, if it is given that current price of the bond is 600, what will be its YTM? So let's do I divide by P. I is the interest. It is stated in the question that Mr. A receive interest rupees 60 annually. So I will write here 60 and P, that is present price. It is stated 600. So when you divide 60 by 600, you will identify 0.10, that is 10% is the required rate of return on this particular irredeemable bond, right? So this is the last thing I would like to explain you regarding bond. If you want to do any further reading on the same topic, you can go through these references. In fact, I have also taken many content in my today's presentation from these suggested references. Now the session is open for your question. You can ask your query. You can just unmute yourself and ask it, or you can post it in a chat box.
Students are requested to ask any query if you have any confusion regarding the topic.
See, this is what we have discussed in our today's session. You can ask any question related to any of the topic.
Okay. Uh, Students are requested to, if you have query in future or if you found some of the query later on, you are requested to inform us. We will ask that particular query to Mithil ma'am, and they will surely give the solution regarding that.
Sure, sir.
Yeah, thank you. On behalf of Faculty of Commerce, Parul University, we would like to thank you for sharing such informative knowledge regarding bond and bond valuation. We hope that our students, as well as other faculties those who are attending webinar from MET as well as Facebook Live, they should have developed their knowledge regarding such valuation version. And also we wish that in upcoming time future we'll also hope that you share another such informations regarding such securities and financial parts. Thank you, ma'am.
Thank you, sir. Thank you, Dr. Divyang Vyas, sir. Thank you, Arpan Patel, sir.
Yeah. Thank you, ma'am.
And thanks to all the students for showing patience while listening me.
So we are completing our session webinar here only. Thank you, ma'am.
Thank you, sir.